Hello and welcome to Portfolio Matters, weekly markets checklist, week 131. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing security that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. So due to scheduling difficulties and Richard still being in France, I'm recording this alone on Friday morning, but we will be including segments I recorded with Stuart Owen earlier in the week. Okay, news this week. The big event of the week was the ECB meeting, and the ECB raised rates by 25 basis points to 4.5%, their highest interest rate ever. And Christine Lagarde refused to rule out further interest rate rises, but the market is expecting that is the peak in EU interest rates and is expecting cuts as soon as Q1 next year as the European economy slows. In the US, we had inflation numbers, and the headline CPI number came in at 3.7% in August, up on July due to rising oil prices. Core CPI continued to fall, coming in at 4.3%, in line with expectations. And the Bank of England has warned that just like the US, UK inflation is likely to rise in August, in our case, to 7.1%. It had a slew of UK economic data this week, which we will go through. Most of it was poor, particularly the GDP number, which came in for July at minus 0.5%, well below expectations. And as I mentioned, oil prices keep on rising. WTI closed above $90 last night, and Brent above 93. The oil market is tight and is forecast by Rystad Energy to be in deficit by over 2 million barrels a day in Q4. Although the IEA is forecasting that fossil fuel use will peak this decade, which is good news, China has overtaken Japan as the world's largest car exporter. So this is the ECB interest rate, and you can see the pace and the magnitude of the interest rate rises are really unprecedented, and the full effects of that are yet to be felt by the EU economy. And despite Christine Lagarde refusing to rule out further interest rate rises, the market is expecting that's the peak and is expecting cuts as early as Q1 next year. So UK economic numbers for July were very disappointing. Now, part of that can be explained by poor weather and strikes, but not all of it. It seems that the UK economy had a poor July. And finally, China has overtaken Japan as the world's largest car exporter, which is very bad for other big car manufacturing countries such as Germany and South Korea. It seems that China has added a lot of capacity to build cars, and actually the Chinese are increasingly buying electric vehicles, meaning that China has an excess capacity in traditional internal combustion engine cars, which it is now attempting to export. And finally, this is the oil price, which looks like it's back in bull market. And on to this week's economic data. First of all, the UK. So, as we discussed, the UK GDP month on month in July came in worse than expected. It was expected at minus 0.2, came in at minus 0.5, a reversal of the rise in June. Year on year is expected at 0.4%. came in at 0. 1 month's data is, of course, volatile, but the numbers are consistent with a slowing UK economy, as you would expect as interest rate rises start to bite. Manufacturing output was particularly poor, down minus 0.8% month on month, although that was better than expectations. Year on year, it beat expectations as well, coming in at 3%. Not too bad, actually. Industrial output missed expectations, coming in at minus 0.7% month on month. Reminder, the difference between industry and manufacturing is that industry looks at the broad scope of industrial production, including chemicals production, whereas manufacturing is a much narrower definition and is mainly concerned with the transformation of metal goods into things such as cars. Industrial output year on year also missed expectations, coming in at 0.4% against 0.5% expected. But that breaks a decent run of negative year on year numbers. Construction output met expectations at 2.8% year on year. The month-on-month numbers, for which I don't have a graph, show that in construction output actually fell 0.5% in July, following a fall of 1.6% in June. It would seem that the construction sector in the UK is slowing fast. The unemployment rate ticked up to 4.3%, in line with expectations. Reminder, it bottomed at 3.5% last August, so that is quite a substantial rise from the lows. Now, the bad news was that we also had wage growth data for July, and that showed wage growth remained way too high and wage inflation persistent. So, excluding bonuses, UK average weekly earnings grew by 7.8% in the year to July, unchanged from June and matching expectations. But including bonuses, it rose again to 8.5% in July, up from an upwardly revised June number and well ahead of expectations. So as of July, total UK wage inflation was still rising. However, if you look at the ONS PAYE data, you'll see that wages appear to have peaked according to the PAYE data. So the median monthly pay in the UK has actually fallen for 2 months in a row now, in July and August. Reminder, the numbers we just showed you were for July. So the data here is showing that in August, wages actually fell further. So wage growth does appear to be moderating according to the latest data. And so according to the PAYE data, in August, median annual pay actually fell to 6.7%, well down from July. So, which raises the question, why was there such a beat in wage inflation in July? Well, that is due to NHS bonuses and strong public sector pay, and hopefully that's a one-off, and in the coming months, UK wage inflation should start to slow. But even the August number of 6.7%, which is well down on the July number, is way too high to be compatible with the Bank of England's 2% target. So further work to do on wage inflation. The other data we had this week seemed to confirm that the UK labour market is slowing. So we had employment change for June, and that was bad, down 207,000 jobs, below expectations, and the second month in a row that the UK economy has lost jobs. And reminder, that is the data for June, so 2 months ago. The claimant count for August only rose slightly by plus 900 jobs, and the claimant count for July was actually revised lower to 7,400 from previously reported 29,000. And so the change in the claimant count was lower than expected. Now, the HMRC payrolls data just seems totally unreliable on a 1 month basis. It seems that it's best to look at it with a 1 month lag. So in July, we previously reported that the UK created 97,000 new jobs, but they've now revised that down to the UK losing 4,000 jobs in July. You'll also note that in June, when the employment change was very strongly negative at minus 200,000, the HMRC payrolls data had 43,800 new employees on payroll. So the latest data for August is the UK payrolls fell by 1,000, but it's far too early to say what the true number is yet. Year on year, the growth in UK payrolls is now just 1.5% and falling. The UK labour market is slowing rapidly. Now, you're turning to the balance of trade. In July, the balance of trade was better than expected at only minus 3.5 billion. Reminder, the UK only goes into a positive trade balance when the economy is doing badly. And finally, we had the Royal Institute of Chartered Surveyors house price balance, and it's a bad number. In August, a balance of negative 68%. Chartered surveyors were reporting house price falls, and that is the lowest number since the Great Financial Crisis. The UK housing market simply does not work at these interest rates. So, in summary, well, it was a generally poor set of economic data which shows a UK economy slowing down towards a recession, even while wage inflation remains far too high and far too persistent. And onto the EU. Not much data from the EU this week, but all of it was poor. So we had the ZEW Economic Sentiment Index, and that fell below expectations, minus 8.9% in September, well down on August. Reminder, that is a survey of analysts and economists, and they think that the EU economy is deteriorating. Industrial production for July came in at minus 1.1% month on month. Like the UK, a very poor number. And year on year, it came in at minus 2.2%, well below expectations. So the EU industry is doing poorly. And the Eurostat also reduced their expectations for 2023 EU GDP from 1.1% to 0.8%, which is still positive, but not by much. So in summary, the EU economy continues to slow, even while the full effects of the rapid rise in Eurozone interest rates to a new record has yet to be felt. Expect the EU economy to slow further in the coming months. On to the US. So the big news was inflation data, and month on month, US CPI met expectations, rising 0.6% month on month, which is a big number and will not make the Fed happy, although that is entirely due to rising oil prices. So year on year, inflation bounced back to 3.7%, higher than expectations and well up from 3.2% in July. Now, if you look at the contributors to US inflation, you'll see that energy year on year was contributing negatively to inflation, and now it's turning neutral on a year-on-year basis, and that will rise in the coming months. All of the other contributors to inflation continue to fall, which is good news, including services inflation. But as you can see, the fall in services inflation is slow. US CPI shelter component is falling, and we've talked about this many times. It is a lagging indicator and will fall slowly over the coming months, and that will tend to drag core CPI down. Other measures of inflation show that inflation is falling, but is still way too high. So trimmed mean and sticky inflation are both far above the Fed's 2% target. So the battle against inflation in the US is still far from won. And the danger is that rising oil prices leading to a bounce in inflation lead to a bounce in inflation expectations and rising wage demands. Supercore inflation, i.e. excluding shelter, is not reassuring because it bounced in August and is still way too high, not coming down. So core inflation in the US met expectations, bouncing to 0.3% in August, up from 0.2% in July. Year on year, it continued to fall, again, in line with expectations, to 4.3%. And that is a good-looking chart. And you can expect core CPI inflation to keep on falling in the coming months. PPI was not great, missing expectations by a margin in August at 0.7%. Year on year, again, bounced to 1.6%, beating expectations, but that's not a terrible number. Core PPI, so excluding energy and food, 0.2%, in line with expectations, and that is a good number. And year on year, 2.2% flat. Okay, onto the US consumer. So we had August retail sales numbers, and those were great, plus 0.6%, up on 0.5% in July, although the July and June numbers were revised lower. So retail sales in August were better than expected. But if you look at the year-on-year number, because of those negative revisions to June and July, the August year-on-year retail sales growth number missed expectations, coming in at 2.5% against expectations of 2.9%. And that's entirely due to those negative revisions. US retail sales in real terms are down 2.2% year on year. So in volume terms, still falling. And as a result of that rise in the oil price, US consumer inflation expectations rose in August. They're expected to fall, they bounced, and that will concern the Fed. Now, the problem central banks face is that rising oil prices are bad for the economy because consumers have to spend more on energy and transport, which means they have less to spend on goods and services. So higher oil prices will tend to slow the economy, but they also feed through to rising inflation at a time when inflation is a big concern for central banks. And what central banks don't want to happen is for rising inflation to lead through to rising wage demands and an inflationary spiral. So, although rising oil prices will tend to be bad for the economy, the danger is the Fed and the other central banks feel the need to raise interest rates further to combat the rise in inflation caused by rising oil prices. And that means the economy will face the headwinds of higher oil prices and higher interest rates, leading to a worse slowdown than otherwise. Used car prices bounced in August, up 0.2% after a run of negative months on months, further evidence of the strength of the US consumer. Reminder that we are expecting the US consumer to face increasing headwinds in the coming months, and in particular as student debt repayments resume in October. And year on year, car prices were down 7.7%. The National Federation of Independent Businesses Small Business Optimism Index ticked down a touch to 91.3, slightly below expectations, and that is still a bad number. But the Johnson Redbook Retail Sales Index year on year, which looks at same store retail sales change, rose to 4.6% last week. So that suggests there's been actually a strong bounce in US retail sales. The US consumer seems to be doing just fine at the moment, despite mortgage rates continue to rise, up again last week, and the mortgage market index continuing to fall. At these rates, very few people are taking out mortgages. Initial jobless claims ticked up a touch, but still not showing any signs of distress, and continuing jobless claims appear to have stabilized. So in summary, the data this week continues the pattern of weak survey data, but strong hard data. So we had the National Federation of Independent Business showing low confidence amongst its members, but strong retail sales data. The US economy just seems resilient while inflation has rebounded on the rising oil price. Core inflation continues to fall. So the Fed meets next week. Let's see what they do. The markets are expecting them to pause. And finally, China. So good news for China is it has escaped deflation. In August, inflation rose by 0.3% month on month, which means year on year, it's at 0.1%. There is no inflation in China. Vehicle sales beat expectations, 8.4% year on year. House prices continued to fall, at falling 0.1% year on year, below expectations. Industrial production, though, good numbers. Year on year, up 4.5%, ahead of expectations. Retail sales, likewise, ahead of expectations at 4.6%. The unemployment rate ticking down. Fixed asset investment below expectations at 3.2%. So all that data shows a Chinese economy that appears to be recovering. And recovering and reorientating itself away from an economy primarily dependent on infrastructure investment to one based on consumption. So good news coming out of China. The question is, can it be trusted? We know that last month, the Chinese government was warning statisticians not to say bad things about the Chinese economy. Are the statisticians merely complying with the government? And on to one chart. Now, I previously talked about how higher interest rates do not appear to be impacting US corporations because they issued lots of longer dated bonds during the pandemic and have locked in lower interest rates. Now, that appears to be true for the S&P 500. But of course, it's only the largest companies that can issue bonds. Smaller companies tend to be reliant on bank credit. And so if you look at the effective interest rate paid by different companies according to their size, you will see that the smaller the company, the higher the interest rate it is paying on its debt. The blue line is the bottom 750 companies in the S&P 1500. You'll see their rate has absolutely shot up. It's only the largest companies in the S&P 1500 that have not seen a huge rise in their interest bill. Higher interest rates are impacting a lot of the economy. And if you concentrate just on the largest companies in the US in the form of the S&P 500, you may get a misleading impression that rising interest rates are not really impacting US corporations. They are, just the smaller ones mainly.
Okay, so last week we were looking at various PMIs and we were pointing out that there seemed to be a bit of a divergence between the S&P Global Services PMI compared to the ISM non-manufacturing PMI. Now, we've looked into this in a bit more detail, and there are some definite differences in the surveys, what they're trying to accomplish and who they're surveying. So here's a little summary of what we've investigated. So this, as a recap, is the ISM Services PMI, basically showing quite an encouraging picture, bouncing up to about 55. Whereas the S&P Global Services PMI showed the opposite picture, having fallen from about 55 to only just over 50. So it looked like they were pointing in different directions. However, there is reason for this. So the S&P Global Services PMI is only data from the private services sector. By contrast, the ISM non-manufacturing PMI is rather broader, and it includes things like mining, construction, and public administration. So oil and gas extraction are, for instance, included in the ISM and not in S&P Global. So they are looking at a very different overall baskets of activity. So other key differences. The S&P Global survey is a bit broader. It's about 400 participants with about an 85% response rate, whereas the ISM is believed to contain about 300. So S&P Global a bit bigger. The S&P Global survey is stratified by company size because it's attempting to represent the whole US economy. By contrast, the ISM is mainly big companies. Another difference is that the ISM is a composite of many underlying individual indices covering new orders, business activity, employment, and lead times and inventories. By contrast, the S&P Global just represents business activity. So the ISM, therefore, is more industries and more measures. So if we look at that in a bit more detail, the ISM shows a strong resurgence in new orders, employment intentions, and prices. So those are factors which aren't necessarily going to be covered by S&P Global. So in summary, the differences between the S&P PMI and the ISM PMI are due to their different designs. One is not necessarily better than the other, but we need to understand that they are looking at different things. So the S&P Global Services PMI is just activity in a survey of the services sector, but the ISM non-manufacturing PMI is broader. It covers mining, oil production and construction, and it's a composite of underlying measures covering more than the S&P Global measure of business activity. So in the recent strength of the ISM versus the S&P Global can in part be explained by the resurgence in the oil price and hence our oil activity. I also wonder whether that's broader, whether there's more happening in the construction sector based on the various of Biden's sort of stimulus measures. You could see how that would be feeding through.
Yeah, although I would suspect that the peak of the Biden infrastructure spending has probably passed. Anyway, thank you, Stuart. Okay, and onto the yield curve as a forecaster of the stock market. Now, over the past year, we've shown you this chart many times, and it shows the difference between the US 1-year and the US 10-year. And when it is inverted, as it is now, that tends to mean, well, that means that the market is expecting US 1-year rates to fall over the next 10 years. And so the 10-year yields less than 1 year. And essentially the bond market is forecasting a recession in the coming period. And when you look at this chart, the gray bands are recessions, and it has 100% record going back to 1953. But obviously, a recession hasn't arrived yet, and the length of the current yield curve inversion is approaching a record. But the S&P 500 hasn't got the message. You can see here that actually since it bottomed in late October last year, it has rallied hard, and it's up, I believe, something like 18% this year, and the NASDAQ is up over 30%. So what is going on? Well, the bad news for equity investors is actually this is not an uncommon occurrence. This chart shows equity market rallies following a yield curve inversion. And the red line is the current equity market since it bottomed in 2022. And you can see that there have been longer rallies following an yield curve inversion, but they have all subsequently unwound and turned negative. You've lost more than you've gained when the recession finally arrives. So, reminder that equities are financial instruments. The net present value of an equity is the sum of its future cash flows discounted by interest rates, and interest rates have risen. Therefore, everything else being equal, the net present value of equities should have fallen, but it hasn't. It has risen. One of the most puzzling things over the last year has been the disconnect between rising bond yields and the failure of equities to fall. In fact, they've risen. So history teaches us that following a yield curve inversion, equities can rally, but that rally invariably fades as recession begins. Now, is this time different, or are we just experiencing a normal bear market rally? Stuart, iBonds.
So I thought this was worth bringing to everyone's attention because I could really see the point of these. So an iBond is basically an ETF of in the fixed income sector. So you might think, well, what's new about that? We've had bond ETFs for ages. But I think that the key thing here is that a bond fund isn't a bond. A bond fund behaves differently to a single bond, essentially because there's no pull to par. So imagine a year ago you thought, a US 10-year bond at 3%, that's reasonable. And in the context of the preceding sort of 5-10 years, you might think 3% was okay. So imagine you bought a bond fund with a 10-year duration. Now, you might think that you're going to earn your 3%, but you're not, or at least not necessarily. Because imagine if interest rates kept rising to 3.5%, 4%, 4.5%, etc. Your bond fund with a constant duration of 10 years is going to keep losing money. Now, if you contrast that with owning an individual 10-year bond, if you wait, then eventually you will earn your 3% because you'll be pulled back to par, plus you'll have earned a coupon. So I think this is so important to realize bond fund isn't a bond. So an iBond, however, is an ETF that tries to mimic an individual bond, but with some other advantages. So it's like an ETF in that it trades very easily on the stock market. It's very diversified. For instance, you might buy an iBond, and if you have a look at the underlying exposure, it could be, I had a quick check, over 600 individual bonds. It distributes the coupons that it receives just like an individual bond would do. And you can get an iBond for instance, the treasury market, for corporates, or for junk. So the difference with between an iBond and a regular ETF of a bond market, however, is that the iBond matures at a set annual point. So you might buy, for instance, a 2028 iBond or a 2032 iBond. Whereas if you buy the normal bond ETF, you're getting, for instance, a 5 to 7 year duration or a 12-year duration, and it always sits there mimicking that duration. So this strikes me as a potentially quite useful product, because buying an individual bond is inherently risky, particularly if you're looking at corporates, and certainly if you're looking at junk bonds. Whereas with this iBond, you could get, say 600 corporate bonds all maturing in whatever year you're interested in, say 2030, and subject to any default risk, that you're going to get the yield to maturity that you thought and you hoped at the point of purchase. So you could build your own bond ladder. And we were speaking in another segment about annuities. But if you're going to manage your own money, a bond ladder is actually quite useful to give you guaranteed income and to know where you stand. So I think the whole series of iBonds maturing in different individual years is a very interesting product, because essentially you've got a much, much higher probability of knowing what yield to maturity you're going to get than you would get if you buy a bond fund. So at the risk of repeating myself, a bond fund isn't actually a bond. It will behave differently, and that's what the iBond can solve.
So just so I have this clear in my head, Stuart. So if you buy, for example, a bond fund with a 10-year maturity, that's going to be buying 10-year bonds and keeping the maturity at 10 years. So let's say at the end of every quarter, it will be selling the existing bonds and buying new bonds with a 10-year maturity. So that means that if you're buying bonds which are trading at a discount, say to par, and over 10 years, those bonds would naturally tend to drift back towards par. In the bond fund, you are missing out on that pull to par over the lifetime of the bond. And the iBonds are designed to get around that problem. Is that correct?
That's it. You're basically going to get the yield to maturity that you think you're getting when you buy it, when you look at whatever data table or data provider you're looking at, you're going to get that because you're holding it to maturity. Yep. Whereas the bond fund is going to be rotating out of bonds as they age and buying newer bonds to keep its maturity constant within a certain tolerance. So it may sound slightly complex, but I think that the point is worth pondering, because the bond funds don't behave like individual bonds.
Right. Okay. Thank you. And on to the US consumer. Now, we have been puzzling over the financial strength of the US consumer and therefore the outlook for US consumer spending. Now, the first thing to say about this cycle is that we're always saying, beware of anyone saying this time is different, because it never is. Well, actually, this time is different because of the massive fiscal spending during the pandemic, which gave US consumers enormous excess savings. So this is a chart showing US savings, aggregate excess savings from the start of a recession. And you'll see during the pandemic, there was an enormous buildup in US savings because of pandemic stimulus. And that has given US consumers the resources to keep on spending over the last 3 years. So the question is whether that stock of excess savings is now depleted and therefore US consumer spending will tend to fall back to more normal levels. Now, this is from the Federal Reserve earlier in the year, and the light blue line is the Fed's estimate of the stock of excess savings in the US. And you'll see they think that the excess savings in the US was already exhausted as early as Q1, in fact, December, whereas in other countries, those excess savings remain and have not been spent down at the same rate. Now, the San Francisco Fed have done their own estimates, and they think that US consumers still have excess savings, but that the excess savings will be exhausted this quarter. We are in Q3 and we're in the last month of Q3. And the reason that those excess savings are being exhausted is that the savings rate is much lower than usual. And so US consumers have been spending down their savings rather than adding to them. But contradicting that is deposit data from Bank of America. So this chart shows the savings and checking balances of US US households with bank accounts at Bank of America by income. But you'll see in each case, in all income streams, savings are much higher than they were pre-pandemic. And so Bank of America would say that there's still a lot of excess savings in the system. So who's right? Well, one way of checking the health of the US consumer is by looking at delinquency rates, and those are absolutely rising. So that would suggest that even if there are excess savings remaining in the US, they are maldistributed. So the wealthier are likely to have excess savings. The poor have certainly exhausted them because delinquency rates are up. And the default rates on credit cards from small US banks have hit their highest rate ever. So that does not suggest the US consumer is doing very well, frankly. And to add to the deteriorating financial position of US households, their net worth has been falling for only the fourth time since the 1990s. Normally, that only happens in a recession. Now, the good news for US consumers is that US wage growth is now higher than headline CPI. So we're having real wage growth in the US. So wage growth is outstripping inflation. But that, of course, excludes financing costs. And we know that rising interest rates mean rising interest payments, perhaps not on mortgages, as we've discussed many times, but certainly on all other forms of debt. And the interest payments of US consumers have been rising rapidly. Now, if you look at interest payments excluding mortgages, then in absolute terms, they're not yet at extreme levels, but they have doubled. Well, they've gone up pretty much, what's that, 60, 80% in the past year. And if you include mortgages, then although the interest burden on mortgages has not increased, the interest payments are back up to above where they were pre-pandemic. So any boost that consumers got during the pandemic from low interest rates has disappeared. And we also know that starting in October, student debt repayments resume. And we've featured this chart last week, and that shows that actually US students have begun repaying those loans early in large size. And this chart shows that US households are finding it difficult to obtain credit. So they've run down their savings, and if they want to try and maintain consumption by borrowing, they're going to find that difficult and expensive. So where does that leave us? Well, economists seem to be in agreement that the extraordinary savings built up by the consumer during the pandemic are now either completely or largely spent. And rising delinquency rates on consumer loans would seem to confirm that. However, the Bank of America data contradicts that and suggests that at least its customers have much more cash on deposit than they did pre-COVID. It's difficult to know who's right, but rising delinquency rates suggest that the Bank of America are only seeing part of the whole picture, and the distribution of the excess savings that remain is important. So in summary, stresses on the US consumer are growing. It's got falling savings, it's rising interest payments, and the resumption of student loan repayments has started. So we'll just have to wait and see how consumer spending holds up over the coming quarters. Stuart, have you got any comments?
Well, I'm trying to put this into a bigger picture. And I think in our previous charts in the weeklies, we've looked at weak US retail sales, at least in real terms, even if nominal, they're just about holding up. But on the other hand, what we've seen, haven't we seen reasonably good numbers in new home construction, broader construction? So is this actually a bit of a twist away from a sort of retail economy towards a manufacturing economy? It was a theme that some economists have been picking up over the past year or so. Could it be that we were actually seeing some sort of rebalancing?
Well, the thing is, I've also read pieces talking about how actually consumer spending is not that important, because what drives an economy into recession, as we've covered many times, is falling construction demand and falling manufacturing demand. But ultimately, who buys houses and who buys manufactured goods? It's the consumer. Yeah. So if consumers start feeling the pinch and cutting back on their goods and services expenditure, then I think that will slow the economy. But it's really too early to tell. Once again, we're getting really contradictory data. And I would say that the Bank of America data is hard data, whereas the Fed and the San Francisco Fed, they are making, they're forecasting. That's not hard data. So we just don't know. And on to equity valuations, Stuart.
So this is quite a topical subject, I think particularly for Keith and me, given how little exposure we've had to the US equity market and how well it's performed. Right, so trying to step back and be a little bit more objective about it. Here are some earnings forecasts for the S&P 500, including forecasts from Morgan Stanley, who heretofore have been rather more bearish on the equity market, though they've slightly changed their opinion recently. So if we look at the consensus earnings forecasts for this year, they're at $222, rising to $249 and then $275 out to 2025. So a pretty healthy performance. That consensus expectation is for 12% growth in 2024, which would be a pretty decent number. So if those earnings forecasts are true, then, as our friend in Primrose Hill points out with this chart, all this talk about the US equity market being expensively valued isn't really true. So you can look here at the turquoise or sort of greenish line showing the underlying earnings per share of the S&P 500. So the underlying E that you're going to capitalize at a PE. And then if you look at the forward price earnings ratio for either the normal S&P 500 or the equal weighted S&P 500, then it's not at the extreme levels that I would have assumed. So the S&P itself coming at 18.9 and the equal weighted at 15.4, both of which are much more reasonable numbers. However, if you look at the free cash flow yield of the S&P against, for instance, the 5-year Treasury, things don't look that attractive. And this is actually quite topical for me because I was looking the other day at Apple because I was aware, obviously, Warren Buffett had bought a massive stake. And I think a couple of episodes ago, Keith was pointing out that this was a stock valued on 30 times earnings, which didn't appear to be growing. So that was sort of the traditional case that the tech stuff was fairly crazily valued. So I was having a look at the free cash flow yield of Apple, because that's obviously something Buffett traditionally focuses on rather than standard earnings. I was expecting to be sort of pleasantly surprised that, oh goodness, Buffett knows what he's talking about, and actually they generate mountains of cash. Well, they do generate mountains of cash, but the stock is so highly valued. It's on a 3% free cash flow yield. And that appears to be quite representative, because if we look overall here at the purple line, that is the S&P free cash flow yield of 3.6%. And even on an equal weighted basis, it's only 4.1%, whereas a 5-year Treasury at no risk is 4.4%. So looking at cash flow yields, well, this does tip the argument back again in favor of thinking the US is expensive. If we look at the Russell 2000, which I think is more the mid and small cap US equity market, there you're having an even more extreme picture with a free cash flow yield of 2.8% against the 5-year Treasury, again at 4.4. Having said that, I think that there must be a lot of sort of biotech and specky stuff in the small and mid cap sections, hence why historically it did have some negative free cash flow yields. So I think there might be some issues with how you, the composition issue there. So equity valuations and interest rates. Now, normally you would think that as yields go up, PEs should go down. And another way of looking at a PE is to look at what some people have called the Buffett yardstick of market cap to GDP. It's a different sort of measure, but capturing the same sort of thing. And that there has been some sort of relationship over the very long term, but not at all recently, where obviously yields have risen. So you would expect market cap to GDP to fall, but it hasn't. Hence the sort of a worrying gap, and why valued people like Keith and me have been nervous at this. So analysts are forecasting rising corporate earnings, which is the basis on which the first chart was indicating that the US equity market doesn't have a high PE because the E is supposed to go up a lot. However, there's reason to think that the E is rather dodgy, and perhaps these analysts are straight lining their earnings forecasts, because the model here from the Felder report is trying to look at what earnings forecasts do in relation to their leading indicator, which is the 10-year yield, the oil price, and the dollar index. If you model the relationship between those leading indicators and earnings, you would expect earnings to be falling, and falling pretty brutally over the next year or so. So down 20-25% rather than up 12% as the consensus suggests. Right, another reason to be skeptical is the comparison of the S&P earnings with the national accounts definition of earnings. Now, the S&P earnings appear to be about 40% above whole economy national earnings, national profits in their national accounts. And historically, that sort of divergence hasn't persisted. And of course, this leads to fears and suggestions and insinuations that perhaps, just maybe, US corporates might be gaming the system and using various techniques to increase their stated earnings. So just to reiterate that the main point, though, that if equities are financial assets, and as Keith was explaining before, that they should be discounted value of their cash flows, then they should respond, equities should respond to changes in yields. And that has traditionally been the case. However, and sorry, if we look at the chart here, that the white line is the 30-year Treasury inflation protected security, i.e. a real yield, and how that has moved with the 5-year forward S&P dividend yield. Now, until 2021, they moved reasonably in sync with each other. But since then, real yields have risen to about 2% now on a 30-year tip. Brackets looks quite attractive to me, brackets. Whereas the S&P forward dividend yield, so even including some dividend growth, hasn't risen. So on a very fundamental basis, it does suggest that equities look pretty expensive. So in summary, compared to its own history, the US stock market, particularly if you exclude tech, that looks to be fairly valued at a P ratio that is close to its long-term average. But do you believe the E in the PE? More fundamentally, compared to bonds, equities do look very overvalued. I'm very struck by that 2% real yield on US tips. That looks like a very attractive bolt hole to me.
Yeah. Thanks, Stuart. Okay, and on to the US fiscal deficit. Okay, so we've been talking about this all year. Now, the latest data on the St. Louis Fed website is actually for the end of 2022. And last year, the fiscal deficit was 5.4%. Now, we did a segment on the US fiscal deficit back in June, where we featured this chart, where the conservative Peter G. Peterson Foundation, who are very concerned about the path of the US fiscal debt and debt sustainability, they were forecasting that the US would have a total deficit of 5.4% again in 2023 and the primary deficit of 2.9%. And using that data, we concluded that the US fiscal deficit did not look out of control. In fact, the primary deficit was forecast to come back in, and it's only staying at 5.4% because of very high interest rates. And as interest rates came down, so would the fiscal deficit, was our conclusion. And the Congressional Budget Office produced this report in May, in which they were also forecasting a fiscal deficit of 5.4%. Now, reminder, the US fiscal year runs to the end of September. We're therefore already included 11 months in to end of August. But since then, it seems a lot has changed. So this is total revenues in the first 10 months of the fiscal year 2023. And you'll see that individual income taxes are coming in down almost 20% compared to 2022. And that is, I believe, mainly due to the lack of capital gains tax because the S&P 500 was down last year. Whereas, if you look at expenditure, it's up due to big cost of living adjustments and more people retiring. So you can see an 11% increase in Social Security and Medicare, but also Net interest up 37%. So Mr. C. Peckham on our Discord posted this chart showing that the fiscal deficit was running at 8.4%. And I thought that can't be true because we covered this 3 months ago and then it was forecast to be only 5.4%. So I did my own calculation using data from the St. Louis Fed. Now, this is the rolling 12-month fiscal deficit as a percentage of GDP. And Mr. C. Peckham is right. As of July, the rolling 12-month deficit is 8.4%, and that is shocking. So if we then look at the monthly deficits, you see there has been a run of big deficits in recent months. Now, the good news is that if you sum the individual monthly fiscal deficits over the first 10 months of the year, the deficit was 1.61 trillion. Now, the Treasury is forecasting that excluding US student debt repayments, the deficit will be 2 trillion. Including US student debt repayments, it will be 1.7 trillion. So that implies that in August and September, the deficit will only be 900 billion. Is that right? God, that's still a huge number. And that implies 1.7 trillion is a deficit of around 6.3%, not 8.4%. And that implies a significant fiscal tightening in August and September. Our US fund manager viewer sent me this, and this shows the change in US fiscal spending, both at the government, the federal, and the state and local level. And you can see that quarter-on-quarter growth on fiscal spending from central government peaked in Q1 at 6% and is now fading. So the fiscal impulse from the federal level peaked in Q1 and is now past. But at the state level, you had a series of big prints. In Q1, it was 4.4% quarter on quarter, 4.6% in Q2, and it is now fading, but still at a high level. And you'll see that state and local expenditure is higher than federal. So the fiscal impulse does appear to have peaked. So in summary, when we last discussed this, all the forecasts were for the fiscal deficit for the year ending September, end of September 2023, to have a US to have a deficit of 5.4%. Over the last rolling 12 months, it's been 8.4%. So the fiscal deficit has been much larger than anyone expected. And that has meant an extraordinary fiscal boost to the US economy, which in part explains the strength of the US economy. However, the fiscal impulse does appear to have peaked, in part due to the resumption of student loan repayments. And we covered this last week. Students have already started repaying their loans early. And hardline Republicans are threatening not to approve the budgets for 2024 unless Biden introduces some measures to reduce the deficit, which is running at extraordinary levels, even if it's only 6.3%. Bear in mind, the US economy is still in expansion. you'd expect that to be much lower to save ammunition so that the US could increase the deficit again when it falls into recession. Stuart, have you got any comments?
Well, just a couple of things to say. There was a title on one of the charts that I thought summed it up, which was crisis era deficits in a non-crisis moment. And they really are, aren't they? That's the more tactical point. And I think strategically, I've seen some coverage of longer term forecasts for the US deficit from the CBO. And that just looks absolutely miserable, doesn't it? Rising expenditures on the US welfare state. But my understanding is that the CBO has to use current policy. So if there is a law passed which is, corporate tax is going to reduce from 25% to 20%, but that's only there for 6 years, and after that will revert to 25%. The CBO has to assume that that will actually happen, even though I think most people would believe that these sunset clauses will never actually be enacted. So the longer term picture looks particularly miserable.
Yeah, I completely agree. Now, since I recorded that segment with Stuart Owen earlier in the week, I have had a conversation with a US fund manager who may have explained why the US fiscal deficit has blown out in the way it has. And his point is that following storms in California, Californian taxpayers were given an extra 5 months grace to file their tax returns. So instead of the 15th of April, they're being given a date of the 15th of September. In addition, ordinary US citizens can request a deferral for their own tax filing date for 5 months. Now, in normal circumstances, there's little advantage in doing that. But when interest rates are at 4.5%, the incentive is to defer your tax return for 5 months and get 5 months worth of interest on your tax liabilities. And apparently that is what a lot of people, including friends of my fund manager, have done. So that implies that the fiscal deficit has been exaggerated because that money is not coming in. It's just coming in late. And that implies that over the coming months, the fiscal deficit should tighten sharply. We will have to wait and see whether his prediction comes true. And on that note, there is looming a possible US government shutdown. Now, you will be thinking, didn't we deal with this in June when they suspended the debt ceiling until 2025? Well, no, that's different. So they have suspended the debt ceiling. Hence, Janet Yellen is issuing vast quantities of treasury bills. And there is no danger that the US government is unable to fund itself. What's happening this time is that in order for the various agencies to fund themselves in the new financial year, they must be allocated funds by the central government. And central government needs to do that by the end of the current fiscal year, the 30th of September. If it fails to approve budgets for the 438 government agencies, then they don't have any cash and they will be unable to operate normally and will have to shut down. And this is not an uncommon occurrence. There have been 20 shutdowns since the 1970s, according to the Congressional Research Service. And the most recent one was also the longest, lasting 35 days between 2018 and December 2018 and January 2019. So where are we? Well, the Republicans have a majority of 4 in the House of Representatives, which would have to approve the Senate's government spending bill. And a hardline right-wing element of the Republican Party is threatening not to approve the government spending on ideological grounds. Now, I've also heard that they're threatening not to approve it on fiscal responsibility grounds, but I can't see any news on that. The items I have seen of their demands are more security on the Mexican border, an end to the unprecedented weaponization of the Department of Justice. By that, I mean stop persecuting Donald Trump for trying to lead an armed insurrection, and an end to woke policies in the Department of Defense, whatever that means. Now, the worry is that next year there are elections in the US, and President Biden appears to have been doing quite well electorally from his fiscal largesse. And the Republicans may feel that they will benefit from drawing attention to the size of the fiscal deficit and from causing a bit of chaos during the Biden administration. So if we turn to betting markets, well, betting markets are actually placing a 2/3 probability on there being a shutdown of less than a week, and around a 38% chance that the shutdown will last longer than 7 days. And that's actually risen quite substantially over the last week. So watch this space. Stuart, any thoughts?
Well, I would say I'm exasperated, but then I come from the UK and I'm rather exasperated by our own experience. No fingers can be pointed.
Yeah, I mean, I think this will only have an effect long term. I mean, it'd be disruptive short term, but it'll only have an effect long term if the Republicans do manage to rein in fiscal spending. And to be clear, medium term, they absolutely need to. You can't go on running fiscal deficits of 6.1% or whatever, 8.4% ad infinitum. At some stage, you need to either cut expenditure or raise taxes.
Well, I think that there's enough blame to go around everywhere, isn't there? I mean, everyone wants to cut generic spending, but no one specifies individual projects or individual benefits that they're genuinely prepared to cut, because the biggest number is Social Security. What are you going to do? You're really going to cut that? There's some of the same problems that we have in the UK, isn't it, with the triple lock?
Yeah.
Democracies, we vote ourselves presents, and we don't like to have them taken away from us.
Well, yes. We vote the biggest voting bloc within the country, sweeties, and then find it difficult to take them away.
Yep.
And on to the Bank of England Credit Conditions Survey for Q2. So lenders reported that they were reducing the availability of secured credit to households, but not really reducing the availability of unsecured credit very much. Mortgage demand keeps on falling. Demand for unsecured lending has been rising. And that tends to be a pattern in recessions. People turn to the credit card to maintain their expenditure. Borrowing by corporations fell slightly, but not actually by as much as you might expect. But the default rate on existing loans has surged for small businesses, though not yet for larger ones. Mortgages in arrears are rising and rising sharply, and that is likely to continue as more households have to refinance their existing low interest rate mortgages onto current much higher interest rates. So in summary, the Bank of England credit survey for Q2 shows credit conditions tightening and rising defaults for small businesses and homeowners. And onto recession watch. Now, back in May, we were talking about the banking crisis in the US. Well, the underlying fundamentals for US small banks have not changed. They're still poor. So US banks have lost deposits now for 5 quarters in a row. And the amount of emergency loans being lent to the US banking system by the Fed through the Bank Term Funding Program continues to rise. Reminder, that is very expensive money at about 5.5%. And so the more money small US banks take from the Fed, the more it undermines their profitability. It may solve their solvency problems, but for how long? And in the coming years, there is a lot of corporate debt that will need to be refinanced at much higher rates. And even in the S&P 500, the largest companies in the US, you'll see that interest expenses are rising. Now, turning to employment, the percentage of the labor force that has been out of work for 15 weeks or more is starting to pick up. And if you look at the chart, a rise in the U1 unemployment rate has always resulted in a recession. The market thinks we're in for a soft landing. Now, it is said, and I don't know how true this is, that California leads the rest of the US, and the Californian unemployment rate has been rising for a while and rising faster than the unemployment rate in the rest of the US. Is that a harbinger? Question mark. Now, non-farm pay. Now, one thing we've covered in recent months has been the negative revisions to the non-farm payroll data, and we've now had 7 consecutive months of negative revisions to the non-farm payrolls, and that's only happened 3 times in history. Previous time, 2008, not a good precedent, but the time before that was 1985, and there was no recession in 1985. So negative non-farm payroll revisions do not necessarily precede a recession. So this is container bookings into all the ports in the US, and that is not a good trend. That is the data to this week, and it shows that goods demand for imports continues to fall. So I find this data difficult to square with rising retail sales. And we saw this week that in August, US used car prices rose. Well, US new car inventories at dealers have been rising, and dealers have been having to offer higher incentives to sell cars. So that suggests new car prices have peaked. Turning to the UK. So earlier we were talking about how US households seem to have spent down most of their pandemic excess savings. That is not the case in the UK, where it is falling fast, but UK consumers still have excess savings from the pandemic, and that will support consumption and support the UK economy. And finally, this is the S&P Global Electronics PMI, and that continues to fall. So further evidence of a slowing world economy. So in summary, there are plenty of indicators that the US economy is slowing. For instance, the continued fall in container shipping, but the US consumer does not seem to have got the message, and retail sales growth has been surprisingly strong. The rise in the US unemployment rate has always been a harbinger of a recession. Is this time different? I don't think so, but the US economy continues strong. Small banks continue to be a problem. They're losing deposits and taking funding from the Fed of 5.5%. We continue to expect further failures of US banks in the coming months. And onto inflation watch. Well, we only had data for the US this week. US CPI rose due to higher oil prices to 3.7%, but core continued falling to 4.3%, still too high. The ECB raised rates by 25 basis points to 4.5%. Now, turning to the US, management teams in the US are no longer mentioning labor shortages to anywhere near the extent they were last year. So, further evidence of more slack in the labor market. And in the UK, this chart shows the percentage of UK hospitality companies that are stating that they intend to raise prices in the coming months. And you see it is falling, and that should hopefully bring UK services inflation down over the coming months. But the UK has a problem with long-term sickness. So these are the number of days lost to long-term sickness from the UK workforce. And you'll see it's been rising. Now, we know that actually people have been coming back into the UK workforce, so I'm surprised at these numbers. But more sickness equals more people out of the labour market and a tighter labour market and inflationary pressures. So the failure of the NHS is leading to higher inflation. And the Bank of England is forecasting that UK inflation will rise in August due to rising oil prices. So the increase in petrol prices will increase UK CPI by 18 basis points and the increase in diesel prices by a further 9. So the expected rise in inflation in August will break a trend of falling UK inflation. Reminder that CPI inflation over the past 3 months annualized has been in line with Bank of England's target. But that's only because we had that drop in the energy price cap in July. In the EU, falling PPI should lead to falling CPI over the coming months. If this chart is to be believed, EU inflation should start to fall rapidly, although you'll notice it has not yet done so. So, in summary, inflation is rising again on the back of the rising oil price. And as I said earlier, the recrudescence of inflation, it presents central banks with a dilemma. If they raise interest rates further to counter it, they risk driving the UK and EU economies deeper into recession. And onto other charts. Well, we've talked before about the weakness of the Chinese property market, and this is just a reminder how expensive Chinese property is. So the home price to income ratio in Shanghai is 50. In very expensive London, it's only 16.7. In New York, it's 10. So Shanghai property is 3 times the expense of London property and 5 times the expense of New York property. It's no wonder that China's having difficulty reigniting its housing market. This chart strongly suggests that China has experienced a house price bubble, and once they're popped, they're very, very difficult to reinflate. Unsurprisingly, Chinese home sales have been weak. And so the red line is the daily home sales in meters squared in China's 30 largest cities. And you'll see been falling every year. And although there's a pickup in August, It's fading again. Home sales are weak in China, and that means developers' sales are weak. And that means highly indebted Chinese property developers are in trouble. If you look at the size of country gardens sales, they are, what's that, a third of what they were 3 years ago? Going to be very difficult for big Chinese property developers to pay their debts. So China is following the path that has led to financial crises in other countries. And Chinese house builders have a lot of bond repayments due in the coming months. But despite that, you saw that the latest numbers coming out of China were quite positive, and JP Morgan is forecasting growth this year 4.8%, which is very decent. And on to good news. And I thought this was an astonishing story. So this is American UN diplomat David Gressly, and behind him is a decaying oil tanker that he helped rescue. So in 2015, when the war broke out in Yemen, this tanker with around 1 million barrels of oil on board was essentially abandoned offshore Yemen and in danger of leaking and leading to a big environmental disaster. So because there's no effective government in Yemen, nobody was doing anything about it. So David Gressly organized a crowdfunding drive and raised $144 million to salvage the vessel, about half of it coming from local businessmen and citizens. And last month, the oil was drained from the tanker and the tanker was towed to port to be scrapped. So amazing what a committed individual can achieve with the help of crowdfunding. And onto equities. Well, it was a great week for equities. This is the World Index up 1.3%, up 13% on the year. The All Share has an astonishing week, up 3%, and that means it's back up 2.5% year to date. I have yet to find any convincing commentary about why the All Share has had such a good day yesterday, which continues today. The Euro stocks also bounced despite the rise in ECB rates. It could be optimism that that is the peak of the rate cycle, and the strength of the Euro stocks is in contrast to the weak underlying data. The reminder, the EU economy is falling into recession, which should be bad for earnings. And rising rates should also be bad for equity prices. But the Euro Stoxx has defied all that. Turning to the S&P 500, another good week, up 1.4%, up 17% for the year, driven by the NASDAQ, up 1.7% and up 33% on the year. And the Hang Seng, not really joining in the party, down 7.9% year to date and kind of flattish this week. Topics, very much joining in, up 1.9% this week, 28% year to date in local currency terms. Bitcoin, highly correlated with risk assets, up 3.2% and 60% year to date. Sterling fell further from its recent peak, but still up 2.7%. Euro down on the year. So weakening Eurozone economy and peaking rates leading to lower confidence in the euro. The dollar index rose again, up 1.6% on the year. VIX, amazing. VIX fell to new lows of 12.8, which suggests to me extreme complacency in markets. So, reminder that we have been in a secular bull market for a long time now, and bear markets do occur, and actually they last quite a long time. So I've been expecting this one to peak, and it seems heading back up to a new high. How long can it last against a backdrop of rising interest rates and the slowing economy? CNN Fear and Greed Index is back to neutral, which is surprising given the strength of equities this week. And markets generally just don't believe there's going to be a recession. If you back out recession probabilities from all the various asset classes, they have tumbled over the past year. S&P 500 is now forecasting only a 22% recession probability, apparently. And analysts are increasingly optimistic about both 2023 and 2024 earnings, raising their forecasts. And they're expecting strong growth in earnings between 23 and 24. And in their earnings calls, companies are no longer mentioning recession anywhere near as much as they did. So companies are also buying into the soft landing story. The NASDAQ continues to massively outperform the Russell, as it's the same ratio to the Russell 2000 it was at the peak of the dot-com boom. So small US companies are not joining in the party. The rise in US equities is very much driven by the big tech companies, which are now a record share of equity fund assets, thanks to retail, which continues to buy. Previously, when we've been talking about Nvidia, I have been deeply skeptical about the valuation, but we've had a debate on the Discord, and the secret fund manager sent me this chart, which shows that on a 2-year forward basis, Nvidia is actually only on a P/E ratio of 27. But you see from the bottom chart, you have to believe that Nvidia's earnings are going to leap over the next couple of years. And while we talk about technology, lest we forget, technology can change very quickly. And what's really surprised me this year, amongst many other things, is the continued strength of Apple, despite falling revenues, and a Chinese market that is turning increasingly hostile. When brands fall out of fashion, they can collapse faster than you might think, as BlackBerry should remind us. And when we talk about technology stocks, this is the ratio of US technology, media, and telecommunications stocks against TMT stocks in the rest of the world. And you'll see that US stocks have outperformed their peers elsewhere by a factor of 3 over the last 15 years, which is extraordinary. Now, that implies either that US technology stocks are 3 times better than elsewhere, or that there's a bubble in US equities. Take your pick. Now, share buybacks in the US are falling, and that will remove a bit of a headwind for US equities over the coming months. Now, we should be entering a period of rising equity market volatility, but that just hasn't happened. As you saw earlier, VIX has collapsed to new year lows. Traditionally, it tends to rise into October. Let's see. And if we follow the seasonality charts, actually, the fourth quarter tends to be very strong. So, can the S&P rally further into year end? Wait and see. Okay, on to commodities and energy commodities, and the oil price is off to the races, up 4.4% last week, up 10% year to date. So that is going to add to inflationary pressures, but also is a headwind for Western economies. WTI has closed above $90, up 4% on the week, 13% year to date. And that was despite actually quite a large build in US oil inventories last week of 11 million barrels. US crude production continued to increase to a new high of 12.9 million barrels year to date, and that's despite the Baker Hughes rig count actually falling by 108 this year. Now, this is the IEA's forecast of world oil supply from the period 2022 to 2028, and they're forecasting that world supply will grow by 5.8 million barrels over that period. And if we believe that oil consumption is peaking on the back of rising EV adoption, and frankly, I've been surprised by the growth rate of EVs, then the long-term outlook for oil prices may be weakening, although short-term, we are definitely back in an oil bull market because oil inventories are very tight and the oil market is back in deficit. Now, we, of course, had a build in oil inventories this week, but overall, US oil inventories are well down on where they were. Turning to natural gas, well, natural gas prices in Europe bounced by 5% over the past week, but are down 55% year to date. We will start using natural gas in size probably from October as the weather cools. But European industry has really cut its gas consumption, and overall, Europe now consumes around 27% less gas than it did pre the invasion of Ukraine. So hopefully that should mean there is less danger of a gas crisis this coming winter. And Russia still supplies 10.3% of European gas. So the danger is, of course, that Russia decides to squeeze Europe by cutting it off, causing another gas spike. In the UK, gas prices rose by 8.4% last week, but they're still down 51% year to date. US natural gas prices also rose, up 4%. Coal has been kind of flat. Uranium continued to rise, up 27% year to date. On to industrial metals. Well, very mixed week. Aluminium was up 1.8%. Cobalt, I don't think we've got any data, flat. Copper, up 2.2%, unchanged on the year, but that is not a bull market. Dr. Copper is diagnosing a weak world economy. Chromium, flat. Iron ore continues to rise. Now, is that saying that the Chinese are boosting fixed asset investment again? We saw the data suggests they're not. Lithium continues to fall, down 65% year to date. Now, the data we use is the Chinese lithium price, and this was sent to us by Simon W., and it shows different lithium prices around the world. And you'll see that they are in broad agreement. So our lithium series does seem to be pretty good guide to real lithium prices. Neodymium continued to recover from recent lows, up 2%, but still down 33% on the year. Nickel going nowhere, down another 1.4%, 33% down on the year. Tin also fading, only up 3.5% year to date. Ferrovanadium, you'd expect it to follow the iron ore price higher. It's going in the opposite direction and having an absolutely terrible year, down 3.6% last week, down 19% year to date. Zinc bouncing back, up 3%, down 14% on the year. So overall, I'd say mixed bag. Some industrial metals having a very good week, others continuing to drift off. Onto precious metals. Well, gold fell by 0.4% last week, still up 5% for the year, and actually doing pretty well against a rising dollar and rising interest rates. Silver also bounced 0.3%, down 3.8% year to date. Platinum down 15% this year, going nowhere. Rhodium down 66%, and we don't seem to have had a new data point in a while yet. Palladium had a bounce, but going nowhere, down 30% on the year. And finally, onto rates. Well, slowing UK economy led to a shift down in the whole yield curve. So the market thinks that UK interest rates are enough to slow the economy and bring inflation under control, despite those very elevated wage numbers we had this week. So that was good news for me and very welcome. And what's noticeable is that while the UK yield curve has shifted down over the last month, the US yield curve has shifted up. The bond market does not think that current US interest rates are enough to bring US inflation under control medium term. And that's despite US inflation being much better than UK inflation. Now, real yields in the US have absolutely surged and are now plus 2% real. And we haven't seen that since the early 90s. And I don't believe the US economy can live with real 2% yields going forwards. As more debt is refinanced onto higher rates, I think it will slow the US economy. And a headwind for the US Treasury market is they are issuing $2 trillion worth of bonds this year. And foreign buyers have backed away from the market after the US seized Russia's holdings of US treasuries. And so this is Saudi Arabia's net foreign assets. And you see, even as Saudi Arabia's revenues have risen with Brent, so it hasn't been recycling those dollars back into the US treasury market. So part of the reason that US yields are so high is the market is worried that there's nobody to buy the vast quantities of debt the US is issuing this year. And everyone is bearish about US treasuries. So Bank of America have scrapped their bullish call on US 10 years, saying they could rise further to 4.75%. Everyone's bearish on US bonds. So this is the UK 2-year. That's still a big number. The market is saying that it expects UK interest rates to average 5% over the next 2 years. The 10-year down a bit, thankfully. The 30-year also down a bit, but still at extraordinarily high levels. At these interest rates, the UK housing market just does not work. US 10-year still rising. Unlike the UK, there's no sign of a peak yet. German 10-year bond yields also do not seem to have convincingly peaked despite the slowdown in the German economy and market expectations for ECB rate cuts next year. If the EU economy starts to slow, you'd expect EU bond yields to start falling. So this is the Italian, again towards its recent highs, Greek. So no change to our views for what they're worth. And concluding comments. This week we saw the ECB err towards caution and raise rates again to a new high and refusing to rule out further rate rises. Inflation is causing central banks problems by rising on the back of oil prices. And we've seen that oil price is rising strongly, and it's a tight market, going to expect it to rise further, and that will add further downwards pressure on the world economy. And frankly, I think the analogy with 2008 is growing. Remember that what finally drove the economy into recession in 2008 was an enormous spike in oil prices. Are we going to see the same again? But for now, the US economy continues to show resilience. And finally, me. Well, I'm having a terrible year, but actually decent bounce on the back of the rise in UK interest, but decent bounce on the rise in UK bond price and the fall in UK yields. I'm massively underperforming everyone. You know the story. I still believe that rising interest rates will slow the world economy and bring inflation down. I think there are signs that is happening in the UK, but obviously I've been way too early. And that is it. Next week, Richard should be back. So it should be service as usual. And we are awaiting the Fed meeting. So to see whether they raise interest rates next week. In the meantime, please can you press like and subscribe to the channel. And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.